Welcome everyone to Portfoliosense Inside the Market Spring 2023 review. Today, me and Peter Robbins will talk you through a look back at quarter one, where markets rose despite turmoil in the banking sector.
So, jumping straight in, global equities as a whole recorded a gain in quarter one of just over 4%, benefiting from receding recession worries in developed markets. These gains came despite the collapse of Silicon Valley Bank, which caused significant volatility in the banking sector. Should you wish to know more about Silicon Valley and what happened there, we did publish an article which covered this event in more detail, which can be found on our website. Moving on to the UK, we saw a gain of about 3.6%. In January, inflation fell to 10.1%. However, a surprise uplift in February to 10.4% hit consumer confidence, as expectations were that inflation would actually fall to about 9.7%. Within the spring budget, the Chancellor said that the Office for Budget Responsibility had predicted that inflation will fall to 2.9% by the end of the year. But overall, the budget did little to boost market sentiment to the UK. The latest quarterly GDP data revealed that the UK economy had avoided a recession by not contracting in Q4 of 2022. However, in its latest quarterly forecast, the Bank of England said that it still expects the country to fall into a recession later in 2023. However, it did expect this to be shallower than previously predicted at the time of striking its previous forecast back in November 2022.
Okay, looking into the US, the collapse of the Silicon Valley Bank caused stocks to dip sharply in March before recovering to finish the month and quarter in positive territory. We also saw the Federal Reserve raise rates twice. But in contrast to the UK, inflation climbed less than expected in March, leading to a speculation that further rate hikes could be limited. Looking at Europe next, here we saw strong gains in quarter one, despite the volatility in the banking sector. In addition to Silicon Valley Bank, we saw troubled lender Credit Suisse being bought by UBS in a deal brokered by the Swiss authorities. Despite this, the financial sector in Europe posting gains for the quarter overall, with Credit Suisse problems largely seen as being contained. Now, the energy shock stemming from Russia's invasion of Ukraine is easing and gas prices have fallen. A mild winter, also meaning energy uses have been lower than expected and gas shortage levels are relatively high. European inflation continues to drop on the back of a significant fall in energy costs and appears to be past its peak. Looking at emerging markets next, so China's economy recovered a boost at the start of the quarter after Beijing loosened its COVID-19 restrictions, which had previously constrained the country's economic growth. However, January's gains were soon retracted as tensions between the US and China increased after the alleged Chinese spy balloon was shot down by the US military. This raised the prospect of further sanctions on China from the US after the ban on selling semiconductors and chip manufacturing equipment to China last year. The best emerging market was the Czech Republic. Mexico outperformed a backdrop of improving economic data, whilst Taiwan and Korea were beneficiaries of optimism about global growth. Peru, Indonesia, and Chile outperformed too. South Africa lagged in the sector, along with Poland and Thailand. South Africa continues to suffer from the electricity crisis. The country was also grey-listed in February by the Financial Action Task Force, given deficiencies in its processes to combat money laundering and terrorist financing.
Moving on to the growth tilts that we adopt within our portfolios. The return of value may not be as high as anticipated, given its relationship with inflation and the high levels of inflation we still see. However, the returns here are impacted more by the underlying sectors which value has a greater exposure to, for example, financials and healthcare sectors, which both saw negative returns for the period, as opposed to the returns of value as a whole. Additionally, sectors like technology, which value isn't heavily exposed to, saw strong returns during Q1 of 2023. So what we see there isn't necessarily a true reflection of value as a asset class, but more to do with the performance of underlying sectors which value is heavily exposed to. The property sector, we can see, was down just over 4% so far this year. It's quite a significant fall in comparison to all the other sectors that we can see on the screen. Part of this is to do with worries over higher financing costs and weaker occupancy rates. However, global property does continue to offer diversification benefits within the portfolios due to its lack of correlation with global equities. Looking at the defensive assets, the negative performance of bonds in 2022 can be largely accredited to inflation, which, as we know, is unfavourable for bond investors due to its inverse relationship with interest rates. However, soft signs that inflation may be peaking may provide more of a tailwind than a headwind in 2023. Fixed income investors perceive these events as indications that the tightening cycle around the globe may be drawn to a close, primarily to combat recessions, and thus anticipate that rate reductions this year may occur. As a result, we've therefore seen broad gains across the asset class, with sovereign debt, corporates, and emerging bonds rebounding from the previous 3 quarters where we saw losses recorded. Obviously, what we have here, and looking at Q1 of this year in investment world, is quite a short time frame. So if we move on to the next slide, we can see that the returns across 5 years are now here, and with the exception of global bonds, everybody is showing positive returns. This is a bit more focused for investments. Whilst 5 years is still a relatively short time frame, at least gives a bit of a broader picture than the last quarter did on its own. I think obviously here we can see that UK has produced 27% and is lagging behind the other developed markets despite everything that's gone on. So if we think about the last 5 years, that includes COVID lockdowns, inflation rising, outbreak of war. So it shows how resilient markets actually are to what's going on in the world. The one bit that I want to point out, which I touched on before on the previous slide, was global property. So despite being down over 4% in the first 3 months of this year, over the last 5 years, it is in positive territory. So again, goes to show you that a long-term view and the long-term benefits that each asset class and sector can bring to a portfolio, short-term isn't a reason to make a decision. So whilst the first 3 months for property this year has been disappointing, over the long term, it still has benefits to the portfolio and has offered a return. The final one I want to point out is global bonds, which this one is showing a small loss of just over 2% over the 5 years. That's more a reflection of 2022 on global bonds, where global bonds saw a big decline in 2022 due to rising interest rates, more so than the global short-dated bonds due to the slightly longer nature of global bonds. It's important to remember that we don't use defensive assets for returns. They're more as a dampener. So whilst, again, over a 5-year period, that negative isn't ideal, that global bonds, even though forming a small part of the portfolios, still have a role to play within them.
Peter, thank you. That just leaves me to conclude, everybody. Thank you for joining us today. As always, no short-term investment predictions, but this is market commentary. I trust you found this review insightful. And that's bye for now.
Thank you.